Hello, everyone, and welcome to another episode of the Financial Advisors Want to Know podcast. I'm Catherine Tindall. I'm a CPA here with Dominion. We're a specialty tax and accounting firm for advisor firms, assisting them with their tax work. And so on today's episode, I have with me a very special CFP, Brooklyn Brock. She is a third generation financial advisor, and she is the founder of Ellevate Advisors, a fee-only, advice-only RIA specializing in financial planning and exit planning for advisors. So she works for advisors for their own situations. Throughout her career, she found advisors rarely do retirement or exit planning for themselves. Despite the importance of these strategies in achieving long-term financial success, that is something I encounter very often as well. With her firm, Brooklyn focuses on helping financial professionals create comprehensive plans to ensure their personal financial future is secure and aligned with their professional goals. So thank you for joining me today, Brooklyn.
Thank you for having me, Catherine. It's a pleasure to be here.
Yeah, we're both advisors to advisors. So a lot
Yes.
of war stories today. I love like what you do because I think for a lot of it, a lot of the advisors that like we always start off with like an assessment process, just getting to know what their goals are because it's hard for me to give good planning advice for the future if I don't know in general where they're trying to go. And so like one of the questions I always ask is like, do you do your own financial advising? Most of them say yes. Some of them work with somebody else. And it's always an interesting conversation because I think for a lot of them, um, their technical ability is very high, but unless they specialize in business owners, they're not used to advising their own situation because when you're running a firm, you've got this huge asset that you're building that's a way outsized part of your portfolio net wealth. Like how you operate that, like how you plan around that, it's so different than say, if you're working with, you have a niche with, federal employees who are retiring. You know what I mean? Like it's just your
Yes.
situation is so entirely different. So it's really cool that you do that kind of work because I think a lot of advisors feel embarrassed when
hmm
they have to admit that they don't know something. But I think it comes down to, at least in my experience, it's kind of an efficiency thing, right? Like if you're not niching with business owners, why are you going to recreate the wheel learning how to do your own stuff versus just lean into the thing that you're strong with?
100%. I mean, I
Okay.
even slightly changed the question, not to just ask like, oh, do you do your own planning? But when did you last update your own plan? Because
Yeah.
like you can think
Yeah.
about yourself in that role, but like, do you actually do it? Yeah, it can be different for everyone, but I definitely agree with the feelings of like feeling guilty almost. I had a prospect call with an advisor yesterday who said, "I don't want to add my wife on the prospect call even though that's what we ask our prospective clients to do because I feel like there's a little bit of work that I need to do learning about the financial factors in our situation and getting things set up that I'm not ready to talk to her about until I understand the implications of these things." And I'm like, I 100% I hear that a lot,
Yeah.
and yeah, it's every advisor feels a little bit uncomfortable opening up about stuff, just like a normal client.
Yeah. Absolutely. Absolutely. No, I get this. I get the same way when I'm working with outside expertise in areas that, my knowledge is very limited in a lot of ways. So it's always an interesting experience when the doctor becomes the patient.
It is.
But so on today's conversation, we got connected over some situations that you've been involved with succession planning, and it's something that is very top of mind. I feel like for every client we work with, and a lot of advisors that I talk to, it's all about getting that successful succession planning done, having a plan for that, having a plan for specifically on the tax side. I think as a caveat, like we'll just do a separate episode just talking about tax implications because that's going to take a fun conversation to a very dry conversation that I don't want to make you have to ride along for. But, in terms of like the practical steps that have to happen from like an operations level, conversational level, internal side of things without thinking about the tax side of things, there's a lot that goes into the succession planning. And so I'd love for our conversation today to kind of focus on some of your experiences there and what you think, having gone through this process with multiple clients of yours through the succession planning process, what advisors need to be thinking about and how they should be thinking about doing these transfers. So any recent scenarios that come to mind that you think our audience should hear about?
Oh my gosh, so many. Where to even start? One thing that often comes up is, okay, this business is the biggest part of your financial plan, but
Yeah.
so often we as advisors don't think with the end in mind of like, okay, what is the succession plan that I'm working towards? Because someday we will not be in our businesses anymore. So if we know what we're building towards, that makes all of these strategic business building decisions along the way so much more straightforward and intuitive, and it reduces stress a lot of the time. So there are so many benefits to knowing what kind of succession plan you want from the beginning. And that's often where advisors come to us. They're like, well, I don't know if I want internal or external. So a lot of the things that I would say, well, these are the implications of succession planning. It hinges on that decision. Is it going to be internal or external? And that can change. Like someone can be working towards an internal succession plan, and then maybe it fails and they reach it out to us because it fails, and then they end up doing an external, a sale to another firm. That's one thing we're working through with an advisory firm right now. And there are different implications depending on which way you go from a compliance standpoint, legal,
Yeah.
all of these good things. So I'm like, well, pick which one because I don't know if we could even do both on our episode today.
Yeah, I would say most of the firms that I've been working with, and I think where it's maybe closer to home, if we can center around like the internal transitions,
Hmm.
just because I feel like external, it's like, okay, this is going to end up being a lot of a matter for the attorneys, and I'm dealing with someone who's not, I don't have a relationship with. And so it's just a very different experience just from that level versus I think for a lot of the firms that we work with, it's, it's internal transitions of, okay, I've got a G2 advisor who's been with me for 10 years.
Hmm.
We need to start moving this over, or like I've got a parent who's got a practice and I'm going to start buying tranches from them, and I haven't been their employee but I'm bringing the practice in. Like those, I think for me those are the most two common scenarios that I come across, because there's a big emotional component that goes with that, and it changes a lot of the conversations than just like, okay, well, who's going to give us the best deal, who's going to be the best good, the best fit for the clients, like are they going to have the strength of the platform, and if purely analytical exercise versus when it's you know more arm's length, it's there's a lot more things you have to work through with that.
Yeah, definitely. And the internal succession plans are often so much more complex. Like you said, with the external, it's almost just like a transaction. There is more that goes
Yes.
into it, but um, you can leave it up to the experts. More so than an internal succession plan where there's so much nuance, the timeline can be stretched out way longer. And in some cases, it should
Yeah.
be to allow the buyer more time to buy out the founder at reasonable market rates. But there's one client that specifically comes to mind. I'm actually not so much helping on her succession planning side, but on the financial planning side. She works for a firm in Colorado, and the founder um, had her buy the first tranche of the company. I think it was like 10%. And so they had a formula for how that was calculated, how much was the down payment, how much was the ongoing, but it's still just 10%. And something I
Mhm.
was unaware of is there's even a certain threshold over which um, I think it's somewhere in the neighborhood of like 20, 25%. From a compliance perspective, you're required to notify your clients that the ownership of the firm has been
Yeah.
reassigned. And I'm like,
Yeah.
oh, so that's something that we've got to watch for. And we find ourselves in the financial planning work pulling in so much of like these business transition strategies into the financial planning conversations because it's all part of this big mush pot of the stuff that's like so hugely important. But she is not related to the founder, and
Mhm.
they're doing this after the first tranche. They're next doing a sweat equity transaction, and she's not having to pay for that like they did in the first tranche. And
Mhm.
so that would still trigger taxable income to her for the
Yep.
portion of the firm that she receives. And it's like, how do they manage the tax implications? Like, I'm not a tax expert. Well, they ended up reaching out to some legal consultants and tax consultants, and they recommended an 83B election to manage the
Mhm.
tax implications. And I just know to say like, oh, 83B election is what they're looking at. I don't fully understand what all that involves, but it's like, okay, so there are different ways to do even an internal succession plan, whether the G2 is buying out G1 or they're doing some kind of sweat equity. I even had another advisor do not even a transition of equity, but she had an agreement for her key employee that said, okay, when the buy sell transaction of the firm happens, when we do sell, the key employee will be awarded with a certain percentage of the sale price. So they don't even have to update the ownership of the firm before the sale happens. So there are lots of ways to provide compensation to people who have added to building the firm over the years without them buying into G2. It just depends on what you're looking to accomplish for the different team members and how they're with you. So I'm kind of trying to differentiate between like equity compensation being different from doing a succession plan. Doing the succession
Mhm.
plan can be a lot more involved from the legal and tax side. But what would
Yeah.
you say to that with this specific example, Catherine? What were your thoughts on that?
Yeah, I think for a lot of these, like when I've seen these situations, for me, it always comes down to the first step of like, what is the practical outcome that we're trying to achieve here?
Hmm.
If you took all the legal and all the tax stuff like off the table from like a practical operational business perspective, like what is the outcome we're trying to achieve? And and that's just between the ownership advisors and their relationship with their G2 or like how that works. And then from that perspective, then I back into like, okay, well, if this is the practical outcome that you're trying to achieve, like maybe there's three different ways we can get there. They're going to have different tax implications. Which one is actually going to be the best structure for us to use in order to get the outcome that you want? And so I always start with that because a lot of times people will lead with the wanting to look at the tax and the legal side first, and it's like, well, those things really need to dance to what the practical outcome needs to be first instead of you
Mm,
trying to decide like, oh well, maybe we don't really know how we want to do this, like let's see what's the most tax advantage. And it's like, well, if it's you want to have a transition done in 5 years, then you know that's going to give us the time horizon for doing projections. Or if like, what's the material facts of what's going on, like is this person going, like do they want to be doing sweat equity, or do they have funds and they want to put funds in and that's practical for them, like where how are you going to do it, and then turning
mhm,
into the like, okay, how's the tax going to pan out? And then once you have those pieces together, does that make you want to change what you're doing practically to try to make it more efficient, or try to change behaviors to get a different tax outcome?
mhm.
So it's like, it always feels like it's really complicated. And then I think once you get to the core meat of what they're trying to get done, which is like, I want to be out of the business in 5 years. Like, okay, great. Like, let's start with that. Like, okay, and we're going to do, more of like an installment sale treatment where they're going to buy me out over 5 years. Or I'm just going to, treat this as sweat comp because I'm going to reduce my hours, but I'm still going to get the
Mhm,
same, I'm going to get a similar payout, or whatever it is, like in those kind of internal negotiations. Um,
mhm.
so that's been my experience with it.
Yeah. Oh, I love that. You made me even think of another client, one of our bigger teams that we're working with. We just helped them go through the process of, okay, what do you want? And
Yeah.
the transaction is so much easier to figure out because that's the transition of the ownership shares, if you will.
Yeah.
But we
Yeah.
see so many firms struggling with transitioning the firm governance, like the management of the business and who makes these
Yeah.
decisions. And
Yeah.
so
Yeah.
we approach that with like this twofold process of like, yes, you have this ownership transition plan and then a firm governance transition plan. And so we helped them map that out at their team retreat at the same time as working on, okay, so one long-standing partner has purchased a more moderate size of the ownership, maybe like 30% of the firm. And they have two other new partners who are buying in, one at 2% and one at 10%. And so they wanted to use the same formula that that first partner buying in got to use because it was a really low rate. But then the founder is like, okay, but the bulk of the business still belongs to me, like majority owner, and he wants to get more fairly compensated. They just went through this succession plan that failed last year where they had another partner buy a big chunk of the business. And that partner came in and turned around and said, okay, we got it for such a good rate. We could go and sell it on the open market and like kind of like you would flipping a house and make so
Yeah.
much more on the deal. And the team called the founder who had retired and he came back in and like bought out that partner who was going down that path. So now he is very aware of the potential arbitrage factors of having given his team such a good deal that if they're not
Yeah.
morally and ethically aligned with the vision of the firm
Yeah.
that they've all been working towards together, that can cause some real issues. So now we're approaching it a little bit differently, where we might not want to give the same super low discount to the rest of the partners who are going to be buying out the majority of the business going forward. But how do we still make it affordable for G2? And
Yeah.
there's not a super long timeline given that they've already been through a failed succession plan. So one thing
Yeah.
that
That's fair.
I yeah, one thing I like that they did is that they were talking to G2 about what it's going to take to buy in. So they set expectations around like down payment, ongoing payments, the equity that they will receive from having purchased their 2% and 10% will, for the most part, cover the payments that they need to make on that. But there was a down payment that they had to save up for. And I think that's something that G1 doesn't think about discussing with G2 very much. And we sometimes just assume that financing is going to be available. But depending on how you want the deal structured and the financing that people will qualify for, that's one of the things to be thinking about sooner rather than later. So when people say succession planning takes 10 years, it's not just because of the tax implications or all of these other moving parts that we have to like, it's extra work in addition to
Yeah.
just managing your firm. It's also like, okay, what can people afford from a cash flow perspective and then the tax perspective on top of it? So when we say like, oh, it takes 10 years to do an internal succession plan, that it could actually be longer for the founder to get a fair market value in the G2 to be able to afford that without like going broke or um, having a huge interest loan. Like there's so many options. Yeah, I just, wow, it can get so complex so quickly.
Yeah, and I think, that story that you have with the failed succession plan, that brings to mind to me like a recent succession project I was working on with an advisor where it was, outside counsel that was assisting with this. And one of the things they really highlighted was having a clause to prevent that kind of behavior where
Yeah.
it's, if G2 goes and then tries to flip at a higher, flip their equity to try to get a better rate on the market within a certain time frame window, then the founder gets part of the arbitrage of the difference on that, post deal. And so it just makes it's one of those things where like, oh, what a messy, if you're doing this with people within your firm that you feel close to, like there's an emotional relationship there, and it's like having to put that kind of language in can feel icky. But it's like you have to go through all that icky all those icky
Yeah.
scenarios when you're doing this planning. Otherwise, like, you just don't know what's going to happen, or what people are going to do. And you're talking about like the biggest asset in your retirement for a lot of these advisors, like especially like some of the multiples I've been seeing from valuation work for some of our clients have been pretty surprising. And I think trying to do succession, like you were saying, with the affordability, like that's a real challenge for a lot
Mhm.
of these practices, just because they want to have the internal succession, but it's just so expensive.
Yep.
If you're looking at like a 3x multiple or a 2.6 or a 2 point, like a more discounted, like 2.2, like depending on where you are, um, it's still really expensive for them to try to finance this. And then once you look at the tax implications, that can just make it harder too. Because a lot of times with these acquisitions and equity changes, as the buyer, you really don't get a beneficial treatment on it. If
Mhm.
you're funding it through profits, a lot of the time you're having to pay tax on it, even though the money's out the door to the G1. So they can be really challenging. So I guess in terms of for advisors, like for things for them to watch out for, of when you've seen these situations go sideways, what are maybe some key points from your experience of things where they might not, not things that are obvious to somebody going through this process of things they need to be wary of, when thinking about the succession planning.
Mhm.
Just a slight interruption in this conversation. I wanted to bring to your attention two things that are important for you to know. So, we're always at the mercy of social media algorithms. So, if you can subscribe to the show, that would mean a lot to me. Even more to me if you can leave a rating and let me know what you think about it. But we have a new newsletter that's coming out. It's going to be very active in 2025, that is specifically around tax issues that I'm seeing advisors face in their own practices, changes in legislations, and the pieces that I think are critically important for you to stay ahead of as an advisor with the new administration. So nearby, wherever you're interacting with this, will be the link of how to sign up for our newsletter. Also nearby will be the link to my LinkedIn, which is the best way to get in touch with me, learn more about what we're doing for advisors in the tax strategy and compliance work that we do, and also to get access to the various tools and interviews and things that I do, specifically designed to help you improve your practice, improve your own tax situation, etc. So let's get back to the episode, and thanks for tuning in.
There are a few different things, and I love that you brought up that clause for the seller to get compensated if the buyer turns around and sells within a period of time. I think that's a great example of the kinds of clauses that we as advisors who are essentially like trying to do our fiduciary duty for clients. Like if we declare bankruptcy, like we have to report it and we might like lose our licenses. Like we're essentially, what I'm trying to say is like we're almost like good people and we don't want to assume that a buyer might take advantage of us. But we also can't control the situation, like what might change in the buyer's situation, in the government and the world. Like there are lots of moving parts. So there
Yeah.
are a host of clauses. My team and I are actually working on a little white paper right now of clauses to protect buyers and clauses to protect sellers and clauses to protect the team that a good-hearted advisor might not think of even putting into a document, but might be just general best practice language to include to provide for some of these outcomes that sometimes happen. So I think there's a lot of detail that we could go into there, but at a high level, I think there are some other best practices, if you will, where I see advisors um, setting out the standard of doing a continuity plan as a
Mm-hmm.
practice run for the succession plan.
Yeah.
And I think for an internal succession plan, that can help G2 understand, okay, what are the factors here? How do I start thinking about the business as an owner? And then they'll be prepared to update the continuity plan once the buy sell transaction is fully completed, because then they'll have to find a continuity partner and it might not be the person they just bought the business from. So it starts putting you in the frame of mind of like, okay, even though we're not doing the buy sell transaction today, what are those clauses that I need to be thinking about to protect me, to protect this person that I'm in business with? Because we usually want what's best for each other in a succession plan. It's not always this like you're negotiating against each other. Like
Yeah.
the well-being of the firm and the clients is what everyone wants at the end of the day. So does that answer your question, or do you want to phrase it a different way? Because I could talk about this forever.
Yeah, I guess probably, maybe to circle back, it's like, have you seen on a tactical level, like more specific pitfalls that advisors can run into? I think probably, like from my perspective, one of the biggest ones that I've seen is where advisors will feel like they've basically done their succession planning just like one-on-one and not bringing in
Mm,
external advisory to help them. And they wait until they feel like they've like negotiated the deal like amongst themselves in order to bring in outside counsel, and then a lot of the time they basically have to kind of start over again, but then there's hurt feelings because
mhm,
the other partner's like, well, we already decided that it was going to be a 2x multiple. I don't care, like that's not fair that you went and they recommended we have to have a valuation done and now it's like 2.6, like, stuff like that. It can end up being, I've seen that as a pitfall, is like not just kind of going through a formal process with somebody and then hurt feelings because, oh, well, I
mhm,
negotiated this, but I didn't understand all these other impacts that kick in at the same time. Like anything that
mhm.
you've noticed on the pitfalls side when people are
Yeah.
starting to do the succession planning?
There are 2 things that stick out to me. One is, the valuation, and the other is private equity. And I'll come back
Mm-hmm.
to private equity, but With the valuation, I'm working with this one advisor who also went through a failed succession plan, and he's now talking to a CPA firm in the area, and they have a lot of mutual clients, so they've worked together over the years. It makes a lot of sense. Operationally, the CPAs have clients that have money to invest, and they have a good relationship with the CPA firm, but they don't do investment management. So the CPA firm is incentivized to have some kind of relationship set up where they can help those clients invest the money and keep all of the business together. So they're looking at the CPA firm owners coming on as owners in the advisory firm practice and starting to buy out the founder. And because they have the CPA background, they didn't, and I don't want to put words onto the situation, but my perception is like there was a lack of trust, or like they wanted something a little bit more thorough in terms of evaluation, because the
Yeah.
advisor had just gotten evaluation from an exit planning company that's very well established, but it's a multiple of revenue. And the tax
Yeah.
firm owners wanted an EBITDA valuation. And so they said,
Mhm.
well, can we do an EBITDA valuation? And the advisory firm owner, who has just been through a failed succession, is like wanting to do anything to make it work this time, goes back
Yeah.
to that exit planning company and says, well, can we do an EBITDA valuation? They're like, well, that's so much more involved than just the multiple of revenue valuation. It's going to be like 5 times the cost. He's like, okay, we're going to do it. And so, like, he just went out and paid for this EBITDA valuation. And one of the things we're coaching them on is like, well, let's go back to the CPA firm owners and talk about why they felt like the EBITDA valuation is needed. Is it worth doing like this hugely expensive additional valuation? Or are there some things that we can talk through and come to an understanding without having to drop like thousands of dollars, but maybe answer some of these questions in a different way? Um,
Yeah.
so that's one thing that it's like, well, there are reasons to do things, but there are also workarounds and conversations to have. It's just such a more nuanced process. So
Yeah, absolutely.
that's one thought. It's not that like you shouldn't do an EBIT evaluation or that the multiple of revenue valuation isn't worthwhile. It's just to like, okay, instead of just paying money, maybe talk about it with someone, like an objective perspective. Some exit planning companies like ours, I'm sure there are others out there, do like this project management work where you're like tagging in the tax professional, the legal professional, and bringing up these concerns so that you don't make the mistake of like spending a lot of money on something and then feeling like you got gypped.
Yeah.
Um, so going on to the private equity, this is such a subjective pitfall. I've had some advisors say, I am a fiduciary. I by no means will ever consider selling to private equity because they're going to do what's best for the company in terms of keeping the profit high, the revenue high, instead of putting the client's well being first. And
Mhm.
then going back to that advisor at the failed succession, um, they were actually considering private equity because those G2s buying in at that 2% and 10%, they aren't going to be able to afford to buy out the founder on a fast enough timeline. So
Yeah.
they were looking into private equity as an alternative solution. They ended up not moving forward with that. But now the founder is going to be left in this position of almost like being private equity for the
Yeah.
firm, where like he'll just be around like as a passive investor, if you will. Um, and so there are so many new companies out there who are offering different ways to do succession planning through private equity. And as we learn more about that, we're starting to understand the implications, but we can't look forward and see the long term implications because these businesses haven't been around long enough. So I think
Yeah.
it really comes back to like, well, what are you looking for from your succession plan? Like if you're looking for top dollar, private equity can pay more than just listing your business for sale through a traditional exit planning company. But like, what do you really want at the end of the day? That's
Yeah.
definitely something to think about. Could be a pitfall that you end up regretting if you move too quickly on a decision. What do you
Yeah,
think about that,
absolutely.
Catherine?
And I've heard this where, people have had some tantalizingly big numbers dangled in front of them from private
Mhm.
equity. And another advisor told me this who was more, working like he was did his own succession work recently and like does some coaching for other people. And he said to me as an aside that He's like, I've never talked to somebody who's done a private equity deal. And then 1 year later, they were like, I'm so glad I did this. And I was like, wow, that's a real tell, versus when people have done the internal succession planning. Like there's so many things that can go wrong, but I feel like the likelihood of things going correctly is maybe more likely, but it's just a it's a fundamental business problem, I think, just the challenge of succession and dealing with it. And I think probably maybe the biggest pitfall that I encounter with people related to this is just, this is a conversation, like if you don't intend to sell your business in the next 20 years, maybe you don't need to be thinking about this very much. But like if you're in a shorter time horizon than that, it's something that you do need to have an idea around, like, okay, what am I going to do with this? Because it can take so long to, okay, well, if I want to have internal succession, like, am I going to find somebody who has their own practice? Am I going to try to raise somebody up within this practice? Like, am I going to just sell to the open market? Because that's going to change how you build the thing too, and what you do internally. But yeah, it's an interesting topic. So for people who are interested in getting in your world, Brooklyn, what is the best way for them? I'd be very interested to see if the white paper comes out by the time this episode goes live. But what's the best way for them to get more resources about, the work that you do for advisors and, getting into your world?
So you can follow us on social media. We're very active on LinkedIn and Facebook and Instagram, but you can also just go to our website, ellevateadvisors.com with 2 L's. And we have more information there about our services. We even have some digital products and templates there for people who are going through an internal succession plan that might be useful. And if the white paper is available, I'll send it over to you, Catherine, and you can maybe include it in the follow-up link with the episode.
Yeah, I love that. So for those of you listening, we'll post nearby wherever you're interacting with this online, how to get in touch with Brooklyn and those social media links. And then if we've got the white paper by then, we'll post some sort of way to access that. But any final thoughts that you have before we sign off, Brooklyn?
I think one of the things that I love seeing about the succession planning process is how much the succession planning can be aligned to fit with an individual's values or a firm's values. And when we incorporate G1 and G2 into the conversation, it starts to really shift and benefit everyone. I see so many G1s trying to do it on their own, but then when they bring G2 into the conversation, it becomes a really beautiful relationship. And G1 has so much more trust in G2, seeing them kind of prove themselves and go through this like leadership development together. And I think that's really what succession planning feels like. And that's why it can take so long, is like you're really growing through this period of life together. So I think it can succession planning can be something that can be overwhelming or super complex, but there are so many people out there who are resources that can make it worthwhile and better and more fun and enjoyable than you ever thought it could be. I would say don't let those feelings of overwhelm keep you from thinking about it and reaching out and making progress.
Yeah, I love that. So for those of you listening, we'll post the resources nearby. And Brooklyn, I just want to thank you again for coming on the show. I appreciate your willingness to share some battle stories with us.
Thanks for having me, Catherine. Happy to come back anytime, and see you all later.
Yeah, sounds good. So this was another episode of the Financial Advisors Want to Know podcast, and I'm Catherine Tindall.